Hello. In this video, we will be talking about capital structure and taxation for startups. So it's legality things which are quite essential. It's legal formalities and legal things which business must understand. So it's a capital structure we are going to understand. And second, the taxation things for startups. Then first thing we'll start with capital structure. What is introduction? Capital is needed for any startup. Definitely. Raising the right amount of capital from the right sources is a crucial element in ensuring the success of a startup. It is also important for the founders to find the right balance between their own funds, equity they raise over and the debt they raise from banks or financial institutions. Moreover, a basic understanding of tax liabilities emerging from the business operation is essential for the smooth operation of the business. Then we have been starting just a minute. Debt versus equity. What is a debt? Debt and equity are two major sources of raising finance. In relation to entrepreneurship, there are several sources of equity funds, which includes own funds, funds from venture capitalists, funds from angel investors. Equity capital has the following features. Equity capital, first thing, it is permanent in nature. There is no obligation for payment of dividend. It involves allotting part of management control. By equity capital, you are giving, suppose you are raising funds from equity, it means you are giving a part of your organization, a part of your capital of your company to someone else. With that, you are also giving a control of your business to someone else. So it involves allotting part of management control. It involves no tax benefits. In equity, there is no tax benefit. And it leads to dilution of ownership. Ownership gets diluted, as I have told you right now, that you are going to give a part of ownership of your company to someone else. So it leads to dilution of ownership. Then what is debt? Debt refers to funds taken as loans from individuals and financial institutions during the starting phase of ventures. Family, friends and banks are typical source of such financing. Debt instruments have the following features. It is cheaper than equity. To raise funds in equity, we have to bear some cost, also known as flotation cost. So in debt is nothing. You will go to a bank and you will ask for loan. So there is no cost of raising debt. Then allows tax saving on interest, because the interest which you pay on tax, because the interest which you are going to pay on the loan or the debt, for business it is a business expenses, and from the profit it gets deducted, and you are going to pay the tax ultimately on the profit which is left after deducting the interest. But in case of equity, what we have seen in the previous slide, equity, the giving of dividend on equity is not a business expenses. Remember this thing. So you're going to face not problem means you have to give more amount of taxation in case of equity, but there is a tax saving thing on debt. It does not involve dilution of control. It is a good thing that if you raise money through debt, it does not involve dilution of control. It has to be serviced regularly with interest payment. You have to pay regular interest. Is compulsory at any cost, even if your firm earns profit or loss. The event of the default leads to bankruptcy and loss of assets. So that is something which is very important. You have to analyze very nicely that. You have to take very big decision before raising funds from that, because if you don't give interest on that, it leads to bankruptcy and loss of assets. So it's very crucial part. Then there are sources from where an entrepreneur can look for raising funds. It's bootstrapping, angel investors, incubators, venture capitalists, financial institutions and banks, and government. So these are all the places from where an entrepreneur can take funds. It can accumulate funds. So this is all about this video, and one more taxation is left. So what is taxation? It's an important aspect for many entrepreneurs. There are basically two types of tax. First thing is direct tax, indirect tax. Direct tax is income tax to be paid on company's net profit over a period of time. Income tax, TDS, tax deductible at source, a mechanism by which the government collect income tax payable by a person at the source of generation of income. Okay, direct tax has two things, income tax and TDS. Indirect tax has two things, which is known as sale tax or VAT, applicable and to be paid on a transaction or sale. Service tax, applicable when there is a service provided for a consideration. Okay, but now it is merged with GST, that is goods and service tax, indirect taxation. So basically these are the taxation measures which you must know. So that's all about this video. We are going to meet in the next video. We will be talking about some new concepts as well. So stay tuned. Thank you.